Hi, thank you for watching Digging to China. I'm Dong Sean. If you have not done so already, please subscribe to my channel. Thank you very much. Due to the sluggish economic recovery in China following the pandemic, the country has experienced a contraction in foreign trade, a decline in property price, and a weak domestic demand, resulting in a continuous depreciation of the Chinese yuan exchange rate. However, there was a recent rebound observed over the weekend. It is evident that this rebound is a result of artificial intervention. It is important not to be deceived by this counter-cyclical adjustment and assume that the Chinese economy is performing exceptionally well. For the wise, it presents an excellent opportunity for cashing out or exchanging currencies. Due to the peak tourist season in Europe and the United States, particularly during the US Independence Day on July 4th, and with the anticipated interest rate hike by the Federal Reserve at the end of July, the Western investment markets have experienced reduced activity and limited news coverage. This situation has created a window of opportunity for the Chinese Communist Party to intervene in the Chinese yuan exchange rate, making necessary adjustments and implementing additional economic measures. These actions are regarded as routine operations in response to the prevailing circumstances. You cannot expect the People's Bank of China to surrender at this stage, while the Chinese economy is currently facing a downward trend with no signs of immediate reversal. One should not underestimate its inertia and the struggle that takes place within this process. Regardless of the perceived foolishness of the CCP's economic policy, it is not as simple as the opposition claims, hoping for an abrupt end. It's important to distinguish between the overall trend and the fluctuations within it. The significant intervention and exchange rate adjustment of the Chinese yuan over the past weekend are part of the oscillations within the economic downturn. If the People's Bank of China does not intervene now, it is likely that by the end of this month, when the Federal Reserve raises interest rates again, the yuan will approach the 7.3 level. Apart from the collective selling of the US dollar by commercial banks, another measure is actively reducing the interest rates on domestic US dollar deposits. On July 1st, the interest rate on domestic US dollar deposits was officially lowered from 4.3% to 2.8%. However, the availability of the 2.8% rate is limited and considered a rare quota-based product. For non-quota-based deposits, the interest rate on domestic US dollar deposit for a one-year term has already been reduced to 2.5%, applicable only to deposits exceeding $5,000. In comparison, the interest rate on renminbi deposit for a one-year term at 1.65% is lower than interest rate on US dollar deposits. The central bank's decision to significantly reduce interest rates for US dollar deposit is primarily aimed at bolstering the value of Chinese yuan. This strategic move demonstrates short-term shrewdness and calculation, albeit lacking a broader vision and direction. The timing of the announcement, made on July 1st, a Saturday when banks were closed, and on July 3rd, the day before the US Independence Day with limited trading on Wall Street, indicates a well-calculated maneuver, taking into account the time difference between China and the US. The objective is to encourage the withdrawal of US dollar deposits, creating a sense of unprofitability for those holding Chinese domestic US dollars. In the short term, this action increases the availability of US dollars in the market, while the central bank concurrently engages in purchasing Chinese yuan as a countermeasure, aiming to curb the depreciation of the Chinese yuan. However, the depreciation trend of the Chinese yuan is irreversible, and the measures implemented by the People's Bank of China only have temporary impact. Firstly, based on past experience, the practice of intervening in exchange rates using interest rate differentials and timing has shown limited and short-term impact, typically lasting for about a week or within a week's trading days. Furthermore, increasing interest rate differentials would also result in the central bank missing out on opportunities to accumulate US dollars and earn interest. So, why would they adopt such measures? The reason behind it is the upcoming announcement of the second quarter GDP figures by the State Council in mid-July. Various departments, including the National Bureau of Statistics and the Customs, are determined to present a more favorable picture of the data and thus exert their utmost efforts in this regard. Because the second quarter's GDP growth rate is closely linked to achieving China's annual economic target of 5% or 4.5%, the data for this period holds great significance. Despite the deflationary trends observed in China's economy during the second quarter, manipulating the GDP figures can still mislead international investors, presenting an opportune moment. Wall Street and the global capital market are primarily concerned with the profit and do not prioritize ideologies, political beliefs, or a country's governance. Although the long-term outlook for the Chinese market may be unfavorable, short-term speculation can yield substantial gains. Consequently, it is crucial for China to project a positive image and perform well on the surface. If the second quarter GDP figures manage to raise market expectations for the Chinese economy, it will further bolster the value of the Chinese yuan. The support for the Chinese yuan relies on economic data and market expectations, which are closely intertwined. As a result, the deliberate reduction of the domestic US dollar deposit rates by China on July 1st is an intervention in the exchange rate aimed at causing an upward adjustment of the overall yuan exchange rate in July. This move is prompted by the anticipated interest rate hike by the Federal Reserve at the end of the month, with a high probability of a 25 basic point increase based on current data from the US market. It is even conceivable that the Fed may directly raise rates by 50 basic points following the release of other significant economic indicators in July. Consequently, the CCP is determined to exert all efforts to boost the value of the yuan before the Federal Reserve's interest rate hike. This necessitates cooperation from various domestic departments to ensure its effectiveness. Failing to take action within this time frame would prove detrimental, potentially leading to the exchange rate falling below 7.3 and possibly reaching levels such as 7.4 or 7.5. Looking forward, even in the medium term such as the next 6 months or a year, it is expected that the Chinese yuan exchange rate will continue to decline as the underlying fundamentals supporting the currency are unlikely to see significant improvements. While occasional interventions and artificial actions by the central bank may occur, the costs and marginal effect of such interventions are expected to become increasingly unfavorable for the Chinese central bank over time. As the founder of Meituan once said, 2019 was the worst year of the past decade, but also the best year for the future. His words have now come true. 2023 can be regarded as the year when the fundamental weaknesses of China's economy, marked by the persistent decline, eventually lead to a collapse. Are there any observable phenomena in the capital market and the domestic social issues in China that can support this perspective? Firstly, let's examine the real estate market. In China, the real estate market serves as both a speculative platform and a reservoir of funds. It is also the primary source of wealth accumulation for Chinese individuals and a significant driver of consumer confidence. A downturn in the real estate market can have far-reaching implications for other sectors. Although Xi Jinping's policy of home for living, not for speculation, may have lost its true meaning, it still exerts a significant influence on market expectations. As the speculative investment decreases and the belief in continuous price growth wanes, people's willingness to purchase properties diminishes. Under the leadership of the CCP, the moral values of Chinese society have become less prominent. The authorities' promise of financial gain and stability is often sufficient to attract buyers, tapping into the inherent nature of human greed. It is crucial not to underestimate the powerful force of human greed, nor to overestimate the CCP's ability to manipulate the economy. This is the culmination of a game where human nature and a lack of shared value converge. Reigniting the flames of human greed becomes increasingly challenging. Moreover, it seems unlikely that the policy prohibiting speculation will be lifted. Consequently, the situation is likely to move in the opposite direction, with people refraining from property purchases, real estate developers struggling to recover their investments, unfinished construction projects remain unresolved, the economy further stagnating, and the value of the Chinese yuan continue to decline. These interconnected reactions form a chain of events. Another aspect worth considering is the export sector, which is unlikely to yield positive outcomes. We can focus on two specific time points and events. The release of the new iPhone 15 in September this year is expected to be a significant event. India's production capacity is projected to account for 15% of the global supply, in addition to a portion of Vietnam's production capacity. This leads to the question of how much domestic production capacity, primarily led by companies like Foxconn in Zhengzhou, will decline. The answer will become apparent when we analyze financial reports and the relevant data. It is worth noting that India only began accommodating flagship iPhone production capacity in 2022, having previously focused on manufacturing the iPhone SE. Within just 1 year, to what extent has the process of de-Chinafication taken place? Can this data provide insight into the overall situation? Moreover, estimates indicate that by 2025, approximately 1/4 of Apple product worldwide will be manufactured in India. Considering the rapid progress of Vietnamese factories as well, it raises the question of how much domestic production capacity will remain in China by that time. Another aspect to consider is the observation of upcoming Christmas orders from Europe and the United States. One key data point to focus on is the freight index of Shanghai Port, which is the largest container export hub in China. This index provides a clear indication of the situation. As of June 30th, it has dropped below 900. In April, the freight index was at 925. This implies that since the beginning of 2023, it has failed to recover after falling below 1,000. Additionally, upon closer examination of the data, it becomes evident that the most profitable routes, such as those between the West Coast and East Coast of the United States, have consistently underperformed. This is why it is argued that the relationship between China and the United States cannot return to its previous state. By analyzing these trade data, the situation becomes apparent. Furthermore, other factors such as employment issues, the number of university graduates, pension and healthcare funding gaps, consumer spending trends, mobile phone sales, and the sales of commodities and automobiles should also be taken into consideration. These factors serve as long-term indicators for tracking the Chinese domestic economy and predicting the trajectory of the Chinese yuan. In conclusion, July may provide a favorable window for currency exchange, but it is crucial to exercise restraint and make prudent decisions when seizing the opportunity. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.